It was an interesting day in the U.S. stock market with the S&P 500 down about 0.68%. But if you looked underneath the hood, you'd have actually found that more stocks were up than down today. Today was the rare day where the Magnificent Seven really sold off, courtesy of some bad news out of Tesla and Netflix and others. So today was a rare day where the technology area was really out of favor, but a lot of the more traditional blue chip areas were actually in favor. In fact, the Dow Jones Industrial Average just completed its 9th straight up session, which is pretty remarkable on a day when the NASDAQ was down 2%. So we'll take a look at all of that, see what it means for our postures. I'm going to explain what it means to have a bullish intermediate confirmation signal in tonight's video, and then we'll take a look at what's going on with the sectors out there, some of the movements within the factor selector, and then we'll get into our trade application example where I wanted to focus on a sold put opportunity within a dividend growth stock in the regional banking space. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's July 20th, 2023. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into the description area. Make sure you're signed up for our email distribution list so that way you can be reminded whenever we post these videos. And also, at the bottom of those emails, you'll find which stocks are giving you overbought and oversold cluster signals within the S&P 500. In addition to that, we're heavy users of Twitter. If you're not doing so already, I would encourage you to follow me at Brandon Van Zee. And we really appreciate those of you that click like and retweet on these Market Outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join our group with that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And as you can see, I've got the heat map for the S&P 500 pulled up here in front of us. I am trying something a little different today, so if this looks a little bit different to you, there is a reason behind that. This is the heat map that comes from FinViz. It is free, which is nice. It is somewhat similar to the heat map that I traditionally will show you on the Thinkorswim platform. But naturally, when we're here on this free YouTube channel, not all of you are going to have access to Thinkorswim. So I figured I would show this one here every so often as well, see how that goes. And I do like some of the colors. They're a little bit brighter here and there, and there's a little bit of additional uses or variants that you can use. For instance, you can go back over the past week or month or what have you, as opposed to just a day. So anyway, this looks a little different to you. That's the reason behind it. This comes from finviz.com, but it's designed to do effectively the same thing that we're used to in my videos, which is to show us which stocks were the biggest winners and which ones were the biggest losers here today. And as you look at this this heat map, it was pretty obvious, at least to me, that we had about a split decision in the market here today. However, you will notice that the biggest companies were in the red today, whereas most of the smaller companies were in the green. So it was kind of one of those days where the tables were turned. Remember, more times than not in 2023, if there has been some sort of a lopsided day like this, it's been the opposite, where most of the big players were in the green and most of the smaller players were in the red. Of course, everybody's talking about the Magnificent Seven in 2023, and all 7 of those closed lower here today. Let's go through them. Microsoft was down 2.31% today, and as you can see when I hover my mouse over one of the ticker symbols with this new heat map setup, it will also show us what some of the performance was of their direct competitors within their industry. So you can kind of see that the sectors are still listed here kind of in the white lettering up above. You see technology, for instance, up and to the left, communication services up in the middle, consumer defensive. You can kind of think of that as the consumer staples, which is right up above and towards the right, and then all the way to the right is healthcare. So those are 4 of the sectors there, and then you have consumer cyclical kind of here in the middle. You can also refer to that as consumer discretionary, and then you've got industrials, real estate, energy, utilities down below and to the right, and then basic materials down and to the right, and then financials are off in the lower left. So anyway, you're still going to have your sectors listed there, but one of the benefits here on FinViz is once you hover your mouse over something like Microsoft, you can then see what their direct competition within the software industry is within the technology sector. So that's kind of a nice little feature there as well. And as you can see, Microsoft was actually one of the worst performing software companies. Oracle was really the only one that was worse, and just barely. They were basically the same drawdown of about 2.3% here today. Within the semiconductors, it was an even more aggressive sell-off. Of course, NVIDIA has been capturing our imagination this year. If there was a story stock of 2023, I would say NVIDIA is it. It was down 3.3% today, but still trading at $455 per share. As I look at this now, I can see that one of the disadvantages to this heat map is it doesn't show us the market cap like it would over on Thinkorswim. So there's some good and some bad associated with it. But nonetheless, NVIDIA, as you can see, was one of the worst performers there within the semiconductors area. You did have a company called Manpower that was down 7.9%. That had been a pretty strong stock up until recently. You also saw that AMD, Advanced Micro Devices, was down 5.3%. So a couple of the bigger losers there. It seems like semiconductors had a tough day. On towards the communications area now. Of course, Alphabet is the big kahuna over there. Some of you may refer to it still as Google, as I do oftentimes. But it was down 2.65% today. Of course, Meta is part of the Magnificent Seven as well, and Meta was down 4.27% today. So not a great looking day there out of the Internet Content and Information Industry Group within the communications sector. In addition to that, down below in the consumer cyclical / discretionary area, Amazon was down about 4% today. Of course, they had a lot of enthusiasm behind their shares last week with their Prime Day, but maybe we got a little bit too far ahead of ourselves there and given some of those gains back here this week. And then one of the worst performers in the entire market today was Tesla. There were maybe a couple of others that were worse. For instance, Discover Financial was down the worst in the S&P 500 today, but it's not nearly as big or as an important of a company as Tesla is. So in most ways, Tesla is way more influential on the end result of the market. Anyway, Tesla was down nearly 10% today, so that was a pretty nasty sell-off. I watched that one briefly yesterday after it had announced its earnings, and the stock was down a little bit, but it was actually quite calm in the initial minutes after the earnings release. So I don't know if something bad ended up getting said in the conference call, or if they had some brokerage downgrades, or what caused this kind of acceleration of this sell-off that nearly had a 10% lopping off of what is, of course, a massive company, hundreds of billions, close to $1 trillion company these days. So that was the sixth of the Magnificent Seven and the worst of them as well. And then Apple is the final one of the Magnificent Seven. It was down 1% today, so it actually fared the best out of the Magnificent Seven, yet was still down 1%, which is a fairly big deal. You remember, Apple is the world's largest publicly traded company, so even when we're talking about just a 1% sell-off, we're talking about billions and billions of dollars of market cap there. So that's where you saw a big chunk of the selling today was really in the most important companies in the entire market. Outside of that sphere, you can see that if you were to look towards the right-hand side here, you have almost clean sweeps, right? It's harder to find selling shares compared to all those that were bid up here today. So it was actually a fairly positive day for the average stock on the market, even though the S&P 500 was down like 0.6 or 0.7% today, which was one of its worst days in a while, on a day when most of the companies were actually up. So a bit of a goofy day from that perspective. Let's talk about some of those winners. One that really stands out to me was Johnson & Johnson. Of course, You guys have heard me talk about Johnson & Johnson over the years as one of those companies I put on my dividend Mount Rushmore. And today was a special day for Johnson & Johnson. It was up 6%. If I heard them right on CNBC, I think they said that was actually Johnson & Johnson's best one-day performance since 2020, so like 3 years. That's not a normal day for Johnson & Johnson to go up 6%, right? Tesla going down 9% is much more common than Johnson & Johnson going up 6%. So that was a pretty impressive day there. And as I mentioned on Twitter, some of you might have seen my tweet here about that just a moment ago. Back here on May 25th, I alerted the Twitter community that Johnson & Johnson had entered the blue zone on the dividend stair-step chart for the first time since 2020. So here's what that chart looked like at that time. Again, this is 2 months ago, approximately, right around Memorial Day here in the United States. And Johnson & Johnson had gone up a little bit earlier in the year and then rolled over and actually touched this blue line right here. That was based upon the newly enhanced dividend where it was boosted from 113 to 119. So that dividend stair-step chart juts higher every time a company raises its dividend. Anyway, as I mentioned in the tweet at the time, said that Johnson & Johnson, the dividend king, is back in the blue undervalued zone based upon the dividend yield theory, which I teach in my dividend growth investing classes here at Market Scholars. And as seen on the attached chart, it's been pretty rare to see it there over the years. The last time it was in that blue zone was March 2020 COVID sell-off. And I use that arrow right there to kind of show you when the last time was before May of this year. It had gone basically 3 years without being in that undervalued territory. So again, a pretty rare feat for it. Previous to that, you'd had to go back several more years, back here to about 2015, 2016, when it spent a little bit of time in that blue zone as well. So remember, when we're looking at the dividend stair-step charts, the average high yield that I use to formulate the blue dividend stair-step line is unique to every single one of those stocks. For Johnson & Johnson, its unique average high yield level is a yield of 3.07%. And on that day, a couple of months ago, it was trading with a yield of 3.08%. And at that time, it was trading at a price around $154, as you can see with the screenshot up here. So it was a pleasant surprise when I woke up today to find Johnson & Johnson rallying pretty furiously, up 6%. And as my follow-up mentioned here just a couple of hours ago, I said J&J is now up 9% since this post less than 2 months ago, featuring the rare entry into the blue undervalued zone of the dividend stair-step chart, dividend yield theory for the win. So had you been buying on that day when I posted it a couple of months ago, you'd have had a reasonably decent result in that. Obviously, 9% is not going to light the world on fire or anything like that, but for a big lumbering giant like J&J, that's actually a very adequate return in just 2 months worth of time. So every so often I do try to alert all of you who follow me on Twitter of companies that are important that are entering into the blue zone to let you know, that might be something that you could consider for yourself for your long-term portfolio. And had you considered that a couple of months ago, you'd be up 9% already. Obviously, they're not all going to work out that way, but I'm happy to provide some of that for my Twitter audience for free. We actually ended up buying it in my dividend growth investing class, in our premium DGI class at Market Scholars during that same week as well. But sometimes I will also keep those of you that follow me for free on Twitter abreast of those important situations there as well. So if you're not following me yet, make sure you do so. Again, my handle is just my full name altogether, Brandon Van Zee. Anyway, back on track here. Sorry. There we go, with the heat map. So J&J was not alone. There were a lot of other healthcare-related names that closed nicely in the green here today. J&J was the best of them, but AbbVie had a nice 3% plus day to the upside. We actually spent a considerable amount of time in my question and answer session for my premium students discussing AbbVie and the differences in the payout ratios across a lot of the different financial sites out there, whether we are using a fully diluted number or whether we're using an adjusted earnings number. So if you're interested in that topic of how to discern between the various financial websites and what they're reporting on earnings per share, feel free to check out that portion of the recording in today's class. It was actually the very first question that I got, so it'll be nice and easy for you to find that if you're a premium member looking for it on the recording. So AbbVie had a very nice day today. We also saw that Bristol Myers Squibb had a very nice day. It was up 2.75% here today. Merck was up nicely, up 2.4%. Eli Lilly was up 2.3%. So all in all, pretty solid performance there in the healthcare space. I think healthcare is kind of primed for a bit of a rebound here, an opportunity to play a little bit of catch up after they've had a pretty difficult start to the year 2023. Other than that, you can see there were other healthcare players that also fared well in different industries within the healthcare sector. Abbott Labs was up nicely today. It was up 4.24%, another dividend king there. We had Medtronic, which is a dividend aristocrat, that was up 3.75% today as well. So another nice performance there out of a couple of dividend growth stocks. Speaking of dividend growth stocks, here's Becton Dickinson. That's another dividend aristocrat company. Doesn't get discussed as much because its dividend yield isn't nearly as high as some of the others. Nonetheless, it does have more than a 25-year streak of raising dividends, and it was up 3.34% today. So again, today kind of felt like a day where the dividend stocks were back in vogue. Finally, it's been a rough go of things for the most part this year. There's been some exceptions to that, but for the most part, it has been clear that this market has been desperate to latch onto the growth trade and has been kind of shying away from most of the traditional dividend stocks. Speaking of dividend stocks, let's talk about some of those big kahunas in the consumer defensive area, or in other words, consumer staples. So Walmart is one of those. It was up nicely today, 1.85%. Coca-Cola was up 1.22%. Some of you might have seen my picture of the home run king, Hank Aaron, and the dividend king, Coca-Cola, united in a photo on Twitter today. So Coca-Cola had a nice day. Pepsi was also up nicely as another dividend aristocrat. They're up 1.63%. Speaking of aristocrats, let's talk about what's going on here in the oil patch. Exxon was up nicely today, up 1.7%. Chevron, also a dividend aristocrat, up over 1% today. Another dividend growth stock that catches my eye, Linde, in the basic materials area, was up nearly 2%. That's another dividend aristocrat right there. And speaking of dividend aristocrats, let's talk about one of the best performers in the utilities space. That's NextEra Energy. The old Florida Power and Light was up nearly 3% today. Look at those nice green numbers there in the regulated electric utility industry group today. Utilities have been sitting out this rally here more recently, but today was a very nice day. On a day where the market was down, utilities were almost a clean sweep to the upside. So great to see them kind of fighting back a little bit there today. We also had some pretty good exposure in the industrials area, some nice winners there. Including some of the railroad companies and including some of the defensive contractor companies, even in some of the waste management companies. Waste management just keeps on chugging higher, up 3% today. Over here on the financials, we also had a very good day. Berkshire Hathaway was up over 1%. Wells Fargo was up nearly 2%. JP Morgan up over 1%. Some of the insurers kind of sprang back to life today. I think Travelers was in the news with their earnings announcement, but Chubb, another dividend aristocrat there, was up 3.2%. Progressive had a nice day. Cincinnati Financial, a dividend king, was up 2.5%. So, it seems like a little bit of activity there within the financials again as well. And then last but not least, I'll just quickly mention IBM. It was part of the underperforming technology sector today, but it, as a dividend aristocrat, was up 2% today. Now, of course, there's nothing to write home to mom about with that stock over recent years, as it's basically flatlined. But at least on a day like today, where money was flowing away from the growthiest types of names out there, maybe it found a little bit of a home within IBM, and it's kind of old school, big blue, mindset that kind of comes with that stock still these days. All right, let's go ahead and pop on over here now to the main part of the platform. and take a look at what the actual numbers were from a market breadth perspective today. When I pull the S&P 500 up on the thinkorswim platform and pull up the index watch visualize area, you can see that there were 284 stocks in the S&P 500 that closed in the green today. Again, remember, the stock market was down today. It was actually one of the worst days for the S&P 500 in a while. Yet there were way more stocks up than down today. 284 in the green, 217 in the red. For those of you that are newer, you might be wondering, how is that possible? How is the market down a bunch if there were more stocks up than down within the market? Well, the reason is because the S&P 500 is a market cap weighted index, and so stocks like Apple and Microsoft and Tesla and those types of companies are going to have a much bigger weighting or influence on the end result of the S&P 500 itself. So when you look at this heat map and you look at how big the squares and rectangles are, the biggest ones are the ones that are most in the red. The smaller ones are oftentimes, as you can see today at least, in the green. Another one I should have brought up, by the way, that was in the red, that was an important one today, was Netflix. Netflix really got hit today. It was down 8% on their earnings announcement as well. They're not really included in the Magnificent Seven, even though they were part of FANG. I was interested to watch Jeopardy here a couple of nights ago, and one of the questions was around, can you name the 5 companies of FANG? And of course that's one that I would have been a rare Jeopardy question that I could have gotten right myself. But it reminded me that, boy, we used to talk about Netflix all the time, didn't we, when it was part of FANG. These days the attention has moved towards the Magnificent Seven, and maybe Netflix doesn't get talked about nearly as much. But today it was certainly in the news with its earnings announcement, and of course a lot of people talking about the writers' strike and the acting strike and all that going on in Hollywood and how that might affect some of these media companies. So today Netflix definitely took it on the chin there as well. So anyway, more than half of the companies were actually in the green today, despite what appeared on the surface to be a poor day for the stock market. Let's take a look at our traditional 4-grid now. This is chart 4B for those of you that are premium members following along at home with your own charting package. And as we pull this up, you can see that the S&P 500 was down 0.68% here today. And again, that's not necessarily like a massive give back or anything along those lines, but considering how steady this market advance has been for quite some time, that's actually one of the bigger down days that we've had in a while. I didn't actually check this on our daily price moves chart, but I'm kind of curious now that we're talking about it. You can see what that candle or that bar looks like here, where it crosses through kind of this yellow horizontal line. That yellow horizontal line is a 0.5% of price move, and the last time we had a 0.5% of price move was 2 weeks ago on July 6th. So this was actually the second worst day of the entire month. And as you stretch that further and further back, you can see that the last time we had even a 1% sell-off day in the S&P 500 was back here on May 23rd. So right around that time, as a matter of fact, of when I tweeted about Johnson & Johnson, now that I look at the date. So back there on May 23rd was the last time the S&P 500 was down 1% at the end of the day. So it has been 2 months since we've seen even a 1% pullback. So that makes today a 0.68% pullback day, actually one of the bigger sell-off days that we've had here in the market more recently. But back over here to our, whoops, sorry, that's the 1 grid. Let's go over here to the 4 grid. Once we're back over here, you can see that with the pullback in the S&P 500 today, it created what is known down below as a bullish intermediate confirmation signal. And since we're on the topic, I will just let you know that 3 out of these 4 charts exhibited the exact same signal. The 3 are the S&P 500, the NASDAQ composite down here in the lower left, and then the Russell 2000 down here in the lower right. For those of you that are newer to this video, you might be wondering, well, what is the bullish intermediate confirmation signal? First of all, you can kind of think of it as a buy the dip signal. That's the whole point of it, is you are looking for an established uptrend with a momentary pullback along the way where you buy that dip with the hope that that uptrend continues the way that it has in the previous months. So as we look at something like the S&P 500, you can see that we're clearly in an uptrend. Remember, if you don't feel like you're confident enough to evaluate that on your own, one thing that you can do when you're watching these videos is just look at the background color of the charts themselves when I'm here on chart 4B. And if the background color of the chart is green, as it is right now, that means that we have a bullish intermediate posture. Right? The intermediate line, as I mentioned on Tuesday, is the green line on the market forecast technical indicator down below. And when you look at the S&P 500 over the last 3 months, you can see that it has mostly been green with very few of these little pink patches in between. And that should be the case, right? This has been a clearly bullish market environment, and the indicator itself is basically confirming that bullishness. So this green line remains in the upper reversal zone above the 80th percentile right now, and therefore we would continue to identify the intermediate trend posture as being strongly bullish. Now, that's one piece of the puzzle to get towards what is known as the bullish intermediate confirmation signal. So bullish intermediate, remember that's not just a random word we're throwing into the signal. The intermediate comes from the intermediate line or the intermediate label that you see right here on the indicator. So bullish intermediate, so we know that the intermediate line is in the bullish territory. Now, on days when the red line falls significantly enough to be in the lower reversal zone, that's what then would constitute a bullish intermediate confirmation signal. The red line moves around much more rapidly than the green line. I mean, you can see that directly on the chart itself. If I were to right click and maximize this, you can see down below that the red line goes from low to high to low to high to low to high to low to high to low to high, and so on and so forth, way more times during a typical 3-month period than the green line. Right? The green line has largely just been hanging out in this upper reversal zone for the entirety of the 3 months, whereas the red line is regularly down below. So the red line is effectively tracking less days, which makes it more sensitive to any movements within the market. So when we have a sell-off day in the midst of an uptrend in the stock market, that red line oftentimes goes into that lower reversal zone, and if we are destined to stay in this uptrend, we will then look back through the lens of history and recognize that that was an appropriate time to be buying the market, not selling it. Now, will this time also represent that? It's hard to say, right? That's what the signal would tell us, but signals also fail. We have to recognize that no technical analysis is 100%. But the way you would kind of think about that is, rather than buying the market when it was hitting a 52-week high yesterday, had you waited for a buy the dip signal known as a bullish intermediate confirmation signal, you could have bought it somewhat on sale today if you were buying, let's say, the S&P 500. So anyway, that's signal exists. Does it guarantee anything? Of course not. This could very well be the top for all we know. Remember, tomorrow is also an important day, not only because we have July options expiration day tomorrow, but remember this whole story that's been floating around here recently about the portfolio rebalancing happening within the NASDAQ 100 ETF and the various indexes out there, where they're basically going to be shaving off some portions of the biggest companies and kind of reallocating that capital into some of the smaller companies. So who knows? Maybe that is the excuse that the market is looking for to start sending some of those bigger Magnificent Seven types of companies lower, which have basically been carrying this market for months and months and months. Obviously, it's a much broader advance today than it was at the beginning of the year, but the Magnificent Seven still remain a critical component of the bullishness that we find ourselves in right now. So who knows? Maybe the market uses that as an excuse tomorrow to start off a chain of events that will start selling the entire market off for the coming weeks or months. We don't know. But what we do know is, as we look back on this chart and ask ourselves a very basic question, had we been buying the stock market every time we had a bullish intermediate confirmation signal in the past, are we happy about it today or not? And I think the answer to that is largely yes. Let's go ahead and double check that. But down below here, it's a little bit easier if your eyes concentrate on the red lines. The green line is largely in the upper reversal zone, which makes it easy because remember, the way that you read the intermediate posture is if the green line is above 80, it's bullish no matter what. If it's below the 80th percentile, then it depends on whether the line is going up or the line is going down. So for instance, back over here in May, you had the green line in the upper reversal zone on May 23rd, which would have been a bullish posture. The very next day, that green line fell out of the upper reversal zone, and that line was pointing lower, which is why the background color at that time turned to pink just for a couple of days before the market recovered. So anyway, the green line is a little bit easier to read, I guess, from that perspective. The red line is going to, as I mentioned before, jut all over the place. So it's going to be, up huge one day, down huge the next day type of a thing. So as we go back over the last 3 months and ask ourselves a very simple question, has the bullish intermediate confirmation signal seemed to work in this current era we find ourselves in? Well, back here on April 25th, we had a bullish intermediate confirmation signal because on that day, the green line was in the upper reversal zone, the red line was in the lower reversal zone. Had you been buying the S&P 500 at 4071 down here, you're happy about it today at 4534. And then it bounced after that and then rolled over again. And then we had another opportunity here on May 3rd, and then also I think on May 4th. Actually there it might have fallen just barely out of the upper reversal zone, but for sure on May 3rd you had the green line still in the upper reversal zone, you had the red line in the lower reversal zone, and so the price of the S&P 500 at that time was 4088. If you bought the S&P 500 at 4088, are you happy today at 4534? I think most people would be. And then we advance further and we have another opportunity right here. I'm not quite sure. Actually, that one I don't think would have qualified because on that day the green line was still just barely going down the day when the red line was in the lower reversal zone. So that one we can probably scratch off. Technically, it wasn't quite there. Let's see what else we can find here. We had another time where the red line went into the lower reversal zone here. But again, the green line was also going down at that time. So that one would also not have qualified, at least according to my eye. This next one would have. So on May 23rd, so again, that was right around the time when I was tweeting about Johnson & Johnson as one example, and of course a stalwart within the S&P 500 itself. Notice the green line was in the upper reversal zone, so whether it was going up or down, since it was above 80, we would consider it bullish, and the red line was clearly in the lower reversal zone. Had you been buying the S&P 500 here at 4150, you're happy about it today at 4534. Then we move on a little bit further. Here's another one where the green line would have qualified this time because it did go up day over day on that day and the red line was in the lower reversal zone. So on this day you could have bought it at the close at around 4177, and if you bought it there, are you happy today at 4534? I think you're probably pretty happy about that. Then we move on to this next one right here where we have the green line clearly in the upper reversal zone, red line clearly in the lower reversal zone. Had you been buying the S&P 500 here at 4270, are you happy about it today at 4534? I think most people would be. Then we move forward here to this next one. This next one may not have worked out quite as smoothly as the others. Nonetheless, it's still a winning trade had you still been holding on to the market until today. Because on that day you had the green line in the upper reversal zone, red line in the lower reversal zone. S&P 500 was at about 4367 at that day, and that was 200 points lower than where it is today. You also had a follow-up that would have been an even better price here on June 26th. Now on that one, I take that back because technically the green line had just fallen out of the upper reversal zone, so I guess that one actually would not have qualified. This other one would have, but this one where you could have gotten slightly better prices technically was not a bullish intermediate confirmation signal, so we can X that one off. But then we advance our chart over here, and this one would have qualified. So had you been buying here at 44.41, you're happy about it. About 100 points higher than that here just a few weeks later. You actually had another bullish intermediate confirmation signal here on July 7th just barely by the slimmest of margins, but it did qualify. And there you would have been able to buy the market just under 4,400, and now it's 134 points higher than that. So you're happy about that decision. And then that brings us to this most recent one here on July 14th. Green line in the upper reversal zone, red line lower reversal zone. Had you been a buyer of the S&P 500 at 45.05, you're still up on your investment here just a week later. So you can see that when we are in the midst of a strong uptrend, as we are right now, the bullish intermediate confirmation signal can be a powerful way to add alpha to your portfolio. Will today's signal deliver that for us? Hard to say, but you could have doubted any one of those, 6 or 7 signals that I rattled off in the last 3 months with very coherent arguments at the time, yet you would not have been correct with your analysis because the market did nothing but just marched higher after that. So anyway, be aware that we do have that signal that exists there on the S&P 500, the NASDAQ Composite, and the Russell 2000. Of those three, the NASDAQ Composite might look to be the most interesting of the three. And the reason for that is, although the blue line is technically not part of the bullish intermediate confirmation signal, we do kind of use that to identify stronger setups. And what we like to see is the blue line somewhere between 20 and 50 on the day of the bullish intermediate confirmation signal. Notice that with the S&P 500, it's almost there, but it's at 57. And on the Russell 2000, it's at 65, so not quite below 50 and above 20. But on the NASDAQ Composite, it is. It's down here at 39, which of course is between 20 and 50. And that just gives us a sense that there was a healthier give back, right? It gives you the sense that you're truly buying a legitimate dip. And with the NASDAQ, that should make sense. Notice the NASDAQ was down over 2% today. It was clearly the laggard of the overall markets today. One thing that I haven't mentioned yet, but is definitely worth mentioning right now, the Dow was up today. And not only was the Dow up today, about 0.47%, which is a pretty healthy move, this was the 9th day in a row for the Dow to the upside. It hasn't done that in quite a few years. So remember when we were talking about the Dow being the laggard here a few weeks back? To my eye, it kind of turned around with that earnings report from United Healthcare, and the stock, or the index, has now been up 9 days in a row. Pretty incredible for the old school blue chip index Dow Jones. And you can see it hit a new 52-week high here today as well. The Russell 2000 was down 0.89% today, so it was the second worst performer after the NASDAQ Composite. But 3 out of these 4 charts were lower today, a fairly significant pullback day. The only one that was higher was the Dow. Yet despite the more sellers, or the more selling, I should say, with 3 out of these 4 charts, we remain with strongly bullish postures on all 4 of our charts despite today's give back. So the nice thing about being in the midst of a robust uptrend is that we have the luxury of giving back a few days here or there and still stay embedded within that bullish posture. So again, bullish intermediate postures on all 4 of these charts. Bullish intermediate confirmation signals on 3 out of these 4 charts. All 4 of these charts are trading above their rising 30-day moving averages, which is a bullish feature as well. And, for the most part, today's selling did not disrupt the uptrends that we are in the midst of. But again, tomorrow's options expiration and a reshuffling of the deck in the NASDAQ. So there are some possibilities of some selling on the horizon, but let's not assume they will happen until we actually see them. Anybody who's assumed that this bullish move this year has been dead upon arrival would have been wrong. So let's wait to see the actual evidence of that. All right, let's go ahead and pop on over here to the internet. I always like to get a chance to say thank you to those of you that help support these free videos that David and I post here on YouTube. As I always mention, they take a lot of time. You guys may not believe it, but it takes 3 hours of our time minimum to produce these full-length videos. We're just a two-man show, so we don't have like a staff or anything like that. So if you appreciate getting access to 3 hours of our day for free, we ask one simple request out of you, and that is to click like for us there on Twitter. That helps at least justify in our own minds that we are trying to run a successful business and get the word out about our organization, and it makes it seem, at least in our minds, whether it's true or not, that it's worth our time to do these free videos for you. So if you get enjoyment out of them and if you get value out of them, that's the one simple request that we have out of you, and it doesn't cost you a single penny. All it costs you is 5 seconds of your time to click like. So let's do some shout outs here today. See who helped us along. Thank you to Roger. Thank you to Ron. Thank you to Ashok. Thank you to Ryan and Sunita and Dr. Bob, who is number 100 here today. Thank you to Brandon and to Business News and to Keith and Doug and Teddy and Arthur and DGI and Options Daily and Dean and Margie and Robert and Tom and HR and Dave and Greg and Jim and Sandeep, Valerie, Dave, Austin, Sheila, Paul, the list goes on and on and on and on. Thank you very much to all of you. I can't get to all of you, but hopefully every so often you hear your name rattled off there, just to a small recognition that we really appreciate those of you that help support David and I in our endeavor here in hopefully educating you all with the markets as often as we do. Also, let's have a little chat about the factor selector tool. Oh, and a reminder, if we're up and over 100 likes, then I'm more than happy to do these full-length hour-long videos like I'm doing right now. So if you prefer the 15-minute shorter version of these videos that doesn't include things like the factor selector or 12 grid analysis or trade applications or all those extra bells and whistles, then don't click like. Remember, we get hundreds of people that actually watch these videos, so we're really not asking much to have 100 of those hundreds of people click like for us. So you actually have it easier than you might be assuming in your head for those of you that like to see these full-length ones. So if you want me to do another full-length hour-long presentation for you next Tuesday when I'm next scheduled to do the video, click like for me. If we're up and over 100, I'll be happy to do that. If we're under 100 likes, then I'll make sure I keep it short and sweet for the rest of you. All right, let's go ahead and talk about our factor selector tool. And as you can see here, we did have one change that was worth reporting, and that was up at the top of the graphic here. Low size factor overtook quality up at the top. Now, keep in mind, low size was also number one the prior week, so they've been kind of flip-flopping there up at the top. For those of you that have heard me talk about this tool over time, you'll know that there are some sector correlations that you'll want to be aware of when we're talking about these factors. When it comes to low size, you have a very healthy overlay of the financial sector. So think about a lot of the smaller banks that are out there in the low size factor. So if the financials sector is doing well, then the low size factor stands a better chance to do well. Quality has a strong correlation with the technology sector, or at least it does in this current era when you've got stocks like Microsoft and Apple that have some of the best credit ratings on planet Earth. And so if technology is really outperforming, you're having an opportunity where quality from a factor perspective is also outperforming. So this could be a couple of ships passing in the night there, where the financials are starting to get a little bit more interesting to the upside, whereas maybe there's a little bit of slippage or at least less bullishness out of the technology sector compared to what we saw just a few months ago. Remember, quality was leading this market from the end of May, basically here to the end of June. It had 6 weeks in a row where it was number one. So it's not as if they're doing poorly here at the number two position. It's possible that they're just not quite as strong on a relative basis as they were a month or so ago. So that was the only thing to report. You can see all of the other rankings held the exact levels of where they were at last week. All right, let's go ahead and pop back on over here to the Thinkorswim platform, and let's do some 12 grid analysis starting with chart 5A. A reminder that when we're looking at these miniature 12 grids here, it is telling you what the current posture is of the entity that is being featured in the chart. using the market forecast technical indicator and using the intermediate line specifically within that indicator. So today you can see that we have a few more pink charts showing up than what we had been used to more recently. So let's talk it through. Usually we start our conversations in the lower two corners. One thing catches my eye right away, and that's down here in the lower right-hand corner. That was quite an interesting bounce today out of TNX. Remember, TNX is how you track the 10-year U.S. Treasury yield. And if you're trying to read the number itself on the Thinkorswim charts or the platform itself, move that decimal point on TNX over to the left one, and then you'll see what the current 10-year interest rate is for the government bond. And you can see that it would be 3.85% today. Now that's fairly typical of what we've been used to seeing here in the last month or so, so that's not what is particularly interesting here. More to the point is this is actually a really nice bounce out of TNX here today. If this was a common stock, I'd be salivating because this would look like a really nice bounce setup for a swing trade. So whether this leads to anything is hard to say, but when the Treasury yields start rising, it makes you wonder if the market is starting to consider the possibility that we're not done with our interest rate raising campaign yet. And if you look for signs of strength within the economy, you don't have to look very far. There is tons and tons of economic activity taking place out there. We talked about that a bit in my Q&A class today, especially when it comes to restaurants and the difficulty in finding workers and all that kind of stuff. So that all plays a role. So we'll see if this leads to anything, but that is an impressive looking bounce right there, and it was enough to change the posture on the 10-year U.S. Treasury yield from bearish when I was with you on Tuesday to today now weekly bullish, in addition to having the 30-day moving average on Tuesday when I was with you be yellow. Today it's back to green because price is back above a rising moving average. So let's keep our eye on that. Remember, traditionally we probably don't want to see interest rates rising. That's usually not a great thing for the market in general, and maybe today was a little bit of a taste of that, right? The S&P 500 was down 0.7% or whatever it was today, and maybe part of the reason is because interest rates were rising once again. So anyway, remember, when the Treasury yields go up, traditionally the bond prices themselves go down because they are inversely correlated. And you can see that that was the case here today across our three different bond categories. TLT was down over 1% today, 1.21%. It is back to a weekly bearish intermediate posture and is trading below its falling 30-day moving average, so kind of like a mirror opposite than what we see with TNX. Foreign bonds were also down today. They were down 0.41%, also have a weekly bearish posture. However, in this case, they're still above their moving average. And then high yield bonds also were down today. They were down 0.44%. Remember, we usually use that as kind of a way to gauge risk appetite, so it's not a great sign when we see those sell off. So they're back to a weekly bearish posture here as well. However, there's a little bit more wiggle room in the case of junk bonds because they were so far above their moving average that even after a pretty healthy give back day like today, they still have plenty of clearance between where they're trading right now and their upward trending 30-day moving average. But yes, today was a nice day for higher yields, a bad day for bonds prices in general. Down below here in the lower left now, let's talk about what's going on with the US dollar. Remember, last week we were talking about how the dollar was basically in a free fall. I mean, that was an ugly move right there. We had 1, 2, 3, 4, 5, 6 straight sessions to the downside for the US dollar versus a basket of other currencies. That is not a normal occurrence, and it's especially not normal considering how aggressive those sell-off days were, right? It wasn't just like a meandering lower for 6 days. I mean, this was a dropping off the face of the earth type of a move right here that we saw. So I guess we probably shouldn't be surprised that maybe we overdid it in the dollar selling. Today, we're seeing a snapback of that. Remember that all else being equal, when you have that type of day where the US dollar is strong, you tend to find weakness in foreign stocks and also in commodities. With foreign stocks, both those categories were down. The developed foreign stocks were down 0.51%, and then the emerging foreign stocks were down worse than the U.S. market, down 0.74%. in terms of commodities, it was a little bit of a mixed bag there. Gold kind of fulfilled the traditional role. It was down on a day where the dollar was strong, but oil seemed to buck the trend for whatever reason. Oil was actually up about 0.5% here today. You'll notice that both gold and oil do remain with strongly bullish postures, even if there was a little bit of stress from a higher US dollar today. Up in the foreign stock world, we have the developed foreign stocks still with the bullish posture. However, the emerging foreign stocks do have a weekly bearish posture here at the moment. We did see that Bitcoin kind of held the line once again today. They have been kind of just grinding lower here on Bitcoin for the last week or so. We're still right there at about a $30,000 level, just a hair below it, but really holding the gains from this immense move that we had in the middle of June. So I think that's a positive sign for the most part, because remember, Bitcoin traditionally is a very volatile asset class, and the fact that you've actually had a very yawn of a move sideways here in the last, call it, month or so, while it's kind of digesting those gains, is actually pretty reasonable in terms of bullishness. It remains above its rising 30-day moving average. Does have a weekly bearish posture, so there's kind of a little bit of conflict there. But for the most part, the fact that it hasn't just plunged back lower is at least worth evaluating. Let's now take a look at what's going on a sector basis. And we'll take a look here at chart 5C for that. Now remember, these are the market cap weighted sector ETFs here. Okay, so from that perspective, we have just one chart that is no longer green, and that is energy. It is weekly bearish with its posture right now in that light pink background color. All the other charts are green. Remember, on Tuesday when I was with you, utilities also had the pink background color, but they bailed themselves out with a brilliant day today. Remember when I was showing you the heat map, nearly all the utility stocks were up. Well, here we can confirm utilities were actually the best performing sector today. They were up 1.83%. Take a look at what that candle looks like right there, and it makes sense why the background color went from light pink a couple of days ago, and now 2 days later you had two straight up moves. This is back to a strongly bullish posture, and that's actually a good move. One thing that I mentioned to my factor-based swing trading class yesterday morning, and something that I also mentioned to them the prior Wednesday morning, is as I was going through the dividend yield factor funds looking for bearish setups, because that was the worst performing factor on the factor selector, so that's how we do that class, what I actually discovered is there were way more bullish dividend charts out there from my perspective than there were bearish ones. And that's not normally what you discover when you're looking at, quote unquote, the worst factor. So to my eye, and again, it's anecdotal at best, but to my eye, for the last 2 Wednesdays, I've actually found that there's been more interesting bullish bounce setups out of the dividend yield types of companies that are out there, not bearish bounce setups. And here you can kind of see why my eye was trained to, let my students know that. You can see here, healthcare is rounding a corner. Healthcare, believe it or not, healthcare is up here basically at a 3-month high. I mean, that is shocking to me, because just 2 weeks ago we were talking about how it was breaking down below the moving average. Well, here we are just 2 weeks later, and we're basically up here at 3-month highs all of a sudden on healthcare. Big chunk of that because of what's been going on with United Healthcare lately after they reported their earnings, and also with some assistance from Johnson & Johnson and AbbVie and some of those other big healthcare companies that are rattled off earlier. So healthcare all of a sudden looks quite intriguing from a market cap perspective, right? That's going to make the UNHs and the J&Js more influential than the smaller healthcare companies out there. They're not alone. If you look at some of these other dividend-focused areas, look at the consumer staples. They've been breaking out to the upside. I noticed one of my old colleagues, James Boyd, tweeting about that recently as well, that, hey, don't fall asleep on the staples right now. They're actually starting to bounce nicely, and in some cases, breaking out, right? If we look at XLP right here, let me zoom in, show you, this has been a solid 2-week move out of the consumer staples. And with today's move, we were able to get up and over this prior double top here. Now, we still got plenty of resistance over here from 3 months ago, but hey, if a reversal is going to be at hand, it's got to start somewhere. Could this be where it starts? Sure. We have some evidence on the chart of that happening. And then also what I mentioned here just a moment ago with utilities. since Tuesday when it had a weekly bearish posture, it has had a really solid back-to-back performance here on Wednesday and Thursday, where we've gone up and up very nicely. And similar to the staples, you actually have a legitimate move up and off of that rising moving average right here, where in this case, on a closing price basis, you did break out of these prior areas in the last month or so, and now you're back here to some of these resistance areas from 3 months ago. Now notice that this particular candle on June 16th on an intraday basis was higher than where we got today, but on a closing price basis, we actually closed higher today on XLU than we closed on June 16th. So all of a sudden, we've got some life there in those defensive areas that focus on dividend payments. At the same time, we're starting to see a little bit of a rollover in some of those traditional growth-oriented areas. Look at technology up there. That's a 2-day sell-off. We only have a 1-day sell-off on communications, but it's given back about a week's worth of gains in one single day. And then discretionary is also just 1 day, but look at how aggressive that candle was today, courtesy of what was going on with Tesla and a few of those others that were out there. But that thing just gave back, 1, 2, 3, 4, 5, 6, basically 7 trading days worth of advances in one single day right here. So you have this rounding up of defensive sectors and a slight rounding down of growth sectors. I think that's the big story right now. Whether it continues, we shall see. But it is something that we want to at least pay attention to, because that would be quite a sea change if that was what was actually taking place right now. So let's see what happens with tomorrow's options expiration period and that rebalancing of the NASDAQ that I had mentioned before. All right, let's get into our trade application example. Now, I've been chomping at the bit to try to do a sold put trade. Many of you know kind of my mode of operation is to sell puts on high quality stocks, dividend raising companies, when the stock market itself is down typically 1% or more. But as I mentioned to you earlier when we looked at chart 6D, the S&P 500 has not had a 1% sell-off day since back here on May 23rd. So I've been chomping at the bit for 2 months to give you a sold put idea. It's actually probably one of my favorite trades. As a dividend growth investor, it's one that kind of combines the idea of long-term investing with a little bit of short-termism in terms of how the options contract can expire every month or so. So it's kind of a nice blend for this particular presentation of the Market Outlook video. But anyway, just wanted to point that out, that it's literally been 2 months since we've had a 1% down day. And remember, it also has to happen on a Tuesday or a Thursday when I'm scheduled to do the video, as opposed to the other days when David's scheduled to do it. So it's been a while. In fact, when I was looking at our portfolio, I noticed we only had one sold put trade remaining. Remember, I had been doing several of them earlier this year, but they've all kind of rolled off of our books at max gain. The only one we have on right now is Sempra Energy, one of those utility stocks that was out of favor here a few weeks ago, but is kind of springing back to life. It was up nicely here, 2% today. We placed this trade back on that day. It was on May 23rd, as you can see from our timestamp down below. So the last time the S&P 500 was down 1% did happen to be a Tuesday or a Thursday when I was doing the video, and on that specific day is when I delivered that Sempra Energy, SRE is the ticker symbol, for a sold put idea. And of course, we've done very well with it, right? And as is oftentimes the case, those are higher probability types of trades. You can see we've made approximately 98% of our profits, and I fully expect that tomorrow we'll capture 100% of our maximum gain there, as this thing will expire out of the money and we'll collect all of that income that we received along the way. So the point is, I've been kind of itching to do more sold put trades for you guys, but the market hasn't been particularly accommodative towards that. So today I kind of bent a little bit, saying, you know what, if the market's not going to give me a 1% down day, then by golly, I still want to do that type of a trade. So I convinced myself today that I'd be willing to do that. So let me explain what it was that I ended up doing. So let me come over here to just look at like a 6-month chart, and I'm going to pull up ticker symbol TFC. This is Truist Financial. I'm not particularly well versed in this company. If I'm not mistaken, I think this is a company that's down in the southeast. Remember, I live out here in the Mountain West, so there are no Truist Financials out here. But when I was visiting some relatives recently in South Carolina, I was reminded of the company as we drove past one of the bank locations there. I think it was the combination of a couple of the regional banks down in the southeast a few years ago. So it's a pretty big player in the regional bank industry. Anyway, Truist Financial, like so many banks, has been woefully out of favor since right here in March when we had the banking crisis. But you'll notice that there's been a bit of a change of behavior in those banking charts here more recently. And they're not alone. You can look at KRE is an ETF that tracks the regional banks. And notice you had this huge plunge back in March, and now you're starting to round the corner. Now you're spending time above a rising moving average as opposed to spending time below a falling moving average. And even if you looked at XLF itself, which is kind of some of the bigger financials in the S&P 500, it's the same thing. Fell out of bed back here in March, has now started to recover and actually start to show a little bit of bullish progress to the upside here with the financials in general. So Truist Financial reported their earnings here and apparently was terrible. I didn't read the report itself, but judging by the activity of the market, they didn't like what they saw because this stock was down 7% today, which is quite the healthy give back there. And oftentimes when stocks are getting hit the hardest is when their implied volatility spikes the highest, and therefore if you're willing to kind of take the gamble, so to speak, on being willing to buy the company at a lower price and sell a put on it, you get more bang for your buck when you're selling puts on days when implied volatility is going higher. And so in this case, notice that with today's 7% sell-off in Truist Financial, it also produced what is known as that bullish intermediate confirmation signal that I was addressing earlier in the video when we were talking about the S&P 500. We still have the green line in the upper reversal zone above 80. It's at 82 right now, on the same day that we have the red line in the lower reversal zone below 20, and it's at 11 right now. So in this case, not only do we have a stock that is still well off of its highs from 6 months ago and actually represents an undervalued dividend play at this level, but now you're actually starting to see signs of an actual turnaround in the stock chart itself being led higher by the sector. So it's not just, a one-man show here trying to turn around on a dime on its own. It's got the help of its entire sector, which is also attempting to do it right now. So what I ended up doing was selling the September 25 puts. And at the end of the day, the final trade was done at 25 cents. I didn't quite get that, but the final trade, some of you might have gotten it at 25 cents. Remember, I send out these trade alerts while the stock market is still open, so some of you might actually end up doing those trades yourself. And usually I target that 1% return on risk area. So 25 cents is exactly 1% of the $25 strike price. So while I didn't quite get that much, some of you might have gotten exactly on that 1% level. And $25, you can see, is an important level to my eye on this chart because it would require this company to actually breach their multi-month and probably multi-year low before our trade would get into trouble. Remember, when you're selling puts, you're effectively putting yourself on the hook for your willingness to buy the stock at the strike price. So in this case, I'm putting myself on the hook to buy Truist Financial at $25 per share in the middle of September if it gets down there. So the hope is now that this thing is trading above its moving average that it continues to coast higher as opposed to doing what it was doing before and coasting lower. So that's what I had for you here this evening. A fairly rare, at least recently, sold put idea that I wanted to get back in the flow of things once again with Truist Financial here. So if you enjoyed that presentation, as I mentioned before, I have one request out of you. Simply click like for us there on Twitter. As long as we're up and over 100 likes by the time I'm scheduled to do the video again on Tuesday, I'll be more than happy to give you another hour-long presentation. On the other hand, if these are getting a little bit long in the tooth for you and you'd prefer just a 15-minute quick hitter version just covering the postures of the market itself, then don't click like. And if we're under 100 likes, then I'll keep it short and sweet for you there on Tuesday. But whatever you decide, I appreciate you checking out tonight's video. I hope you all have an excellent weekend. I'll look forward to seeing many of you early next week. Take care, everybody. Bye-bye.